Bitcoin pops back above 42K. Are sellers finally getting exhausted? As GBTC outflows continue to trend down and Blackrock ticks past $2 billion in assets under management, will we see real price discovery in the market? What can the AI markets teach us about the ETF markets? Plus, with US debt interest payments reaching $1 trillion, this leads us to look at Ray Dalio's 3 indicators to watch for when a country's fiat currency is ready to collapse. Spoiler alert, it doesn't look good. Do you have enough Bitcoin? Welcome to the Friday, January 26th edition of the Bitcoin ETF Daily Show. I'm Dante Cook, head of Swan Business. In this show, we discuss the latest news, events, winners, losers, and key information surrounding these historic Bitcoin ETFs. Here at Swan, we're on a mission to educate the world about Bitcoin. So please like this video and subscribe to this channel to extend our reach and help us cut through the noise on YouTube. All right. We're going to start the show by introducing a new financial term for all of the markets, the dusting dividend. It's a dividend provided by Bitcoiners who are providing value for all shareholders and to troll the poor person whose job it is to account for the additional redemptions in the fund. We had some questions after yesterday's show about what happens to the Bitwise sats that were dusted to the Bitwise ETF public address. Well, their CIO, Matt Hogan, had this to say: all assets accrue to the benefits of shareholders. That's open source value for everyone. You gotta love it. Bitcoin's price has seen a nice spike of 6% over $42,000, with trading volumes being up 34% on the day. On to our flow numbers. GBTC saw 394 million in outflows yesterday, which has now continued to decrease the last 3 days. GBTC's discount to NAV has closed completely and even traded at a premium yesterday. And based on today's data, BlackRock's IBIT volume suggests that it may soon be the trading volume leader, overtaking GBTC at the top. And you heard it here first. For the first time since the launch of the ETFs, BlackRock and Fidelity's volumes combined are trending to surpass the daily volume of GBTC. This means that GBTC may not be the main driver of volumes, inflows, and outflows for that much longer. But even with that positive news, yesterday we still had about 80 million in net outflows across the ETF issuers. When discussing volumes, let's remember that most ETF trading activity occurs in the secondary market, where ETF shares trade hands between buyers and sellers. In Q4 2023, BlackRock states that the ratio of secondary market activity to primary market activity in the US was 8-1, meaning for every $8 of ETFs traded, which does not impact the underlying securities of the ETF, only $1 resulted in trading activity in the underlying securities. Back to our flows. BlackRock will likely end the day today with over $2 billion in Bitcoin. And after yesterday, ARK, Cathie Wood's firm, is firmly in third place over Bitwise with over 13,000 Bitcoin in their holdings. And why the big jump? Well, a large portion of this is because they're purchasing their own ETF through shares of their other funds. In their defense, they are exiting their BITO positions, which is a Bitcoin futures product. But it's sort of like taking money from your left pocket and putting it into your right pocket. Let's pause for a moment and take a quick detour for me to provide an illustration that I think is relevant to share how ETFs work, using the recent investment boom in AI as an example. In a new show, BG2, with Brad Gerstner and Bill Gurley, Silicon Valley OGs, they talked about how main companies, Microsoft, Amazon, Nvidia, and Google, are doing this with their AI investments. These main companies, like Microsoft, invest in companies like OpenAI or Amazon with Anthropic, where they issue credits. And those credits are then used to purchase server space or compute power back from these large vendors, who then count it as revenue. You do me a favor, and I do you one. Well, in a different but also legal way, ETF issuers do the same thing. Whether they're publicly disclosed seed investors or institutional partners, these authorized participants work with their institutional partners, pension funds, endowments, hedge funds, CIOs, RIAs, and ask them to invest into their newly issued ETFs, usually at a discount or free, or for marketing credits to help them support growing their firms for a certain amount of time. So in effect, what happens is these ETF issuers get lots of flows into their funds for a certain amount of time to boost their position or their ability to be atop in the market race, like BlackRock or Fidelity. And in return, their partners get lots of assets under management, which they can make fees with. The larger the ETF issuer, the larger number of investors or investment dollars they're able to have that consistently seed flows into their products early on. So although we are continuing to see steady flows into these major ETFs, know that there's likely a large amount of these revenues that aren't coming from your brother-in-law, but your Uncle Frank, who's a CIO at a pension fund. In fact, according to Blackrock, individual investor trading activity in ETFs represented only 15% of all ETF trading volume in 2023. Flows are flows, but after the first month, we will likely have a more accurate picture of who's actually generating organic demand for their products. And another ridiculous up and to the right chart. A viral chart has popped up all over Twitter showing a projection from the latest Q4 GDP report that interest payments on federal debt now exceed $1 trillion and are projected to reach $3 trillion by Q4 of 2030. It doesn't account for some basic things like interest rates, but the point is still valid. Debt is exploding, and the payments on that debt are rising just as quickly. I guess Uncle Ray was right.
Time and again, the clearest indicators of when a fiat currency is going to decline into a collapse is when those who are holding its debt sell the debt, and the government, central bank, has to print money to buy that debt in large size while that's going down. Those are the most important indicators. So that you can see it, again, I want to repeat, selling the debt so that there's a big supply-demand imbalance, and the central bank having to come in there and buy the debt that no one else will buy in large quantity, so that then there's a currency devaluation. You have those three things aligned, the currency devaluation going down at the same time as those other two things are happening. And that's been a classic. It's like a bank run. They come to the bank, there's not enough money in the bank, and so they have to make up the difference by the printing of money.
Traditional debt holders are selling. Central banks have no choice but to step in and buy that debt that no one else is willing to. And then there's a currency devaluation. Lynn Alden has mentioned that she believes the United States economic environment will likely begin to look more and more like a developing country, experiencing rapid currency devaluation versus the normal depressive deflationary bust, where the world crashes all at once. Their citizens take their fiat currency and do whatever they can to store their wealth into harder assets, usually dollars. Well, what happens when the dollar devalues? The smart investor will buy Bitcoin. With Bitcoin ETFs now holding 3 to 4% of total Bitcoin supply, what happens when we reach a point when hodlers won't sell, when supply decreases after the halving, and liquidity dries up to only a small portion of uninformed sellers? Why buy anything else? As Jeff Booth says, everything is collapsing in price against Bitcoin.
If you don't hold Bitcoin, your prices are going up. If you denominate in Bitcoin, all prices are coming down, and they will forever.
And with that, that's the end of our show. If you enjoy these shows, please subscribe to the Swan YouTube channel for the best Bitcoin content out there. I'm Dante Cook with Swan.com. We'll see you back in roughly 432 blocks. Have a good weekend.